Goldman Sachs cutting its oil price forecast by nearly 10%, lowering its outlook for December Brent to $86 a barrel from $95 and WTI from $89 to $81. Joining us now is Jeff Currie, Goldman Sachs Global Head of Commodities Research. Jeff, it's good to see you. We've had you on many times, and I think part of your commodity supercycle thesis that we were in had to do with oil. Things changed. Have you sharply adjusted your opinion and your outlook on things? What happened?
No, we haven't changed the longer-term supercycle thesis at all. In fact, if anything, it's gotten stronger with the pullback in prices. Underinvestment is pervasive across the commodity complex, particularly oil. Just look at U.S. drilling. Why did we cut our near-term price targets? It's the policy response to the high prices from last year, and it's threefold. One, you had the SPR. And they're still taking barrels out of the SPR and don't start really putting them back in until next month. Two, you had the monetary response to the inflationary pressures. That's creating a massive amount of destocking. And the biggest one right now is a more discerning approach towards sanctioned oil. In fact, the core of this downgrade was driven by a 600,000 barrel per day upgrade to sanctioned oil. Russia, Venezuela, Iran, all producing substantially more than what we would have expected. And so we can think about the higher interest rates, driving this because you're destocking sanctioned Iranian barrels out of floating storage. And so they're looking for places to get new oil, and that's one of them. And also you have the infrastructure available. But does that change the longer term story? Absolutely not, because you're not getting any more out of Russia because of the lack of investment. Iran hits infrastructure constraints, and in Venezuela, they're talking about years of investment to get more capacity out of it. And a lot of people are worried about oil. They go, well, we cut back production in OPEC, that creates spare capacity. But I want to remind everyone, we're likely to draw 2 million barrels per day during the third quarter with that reduction in supply. So, the bullish thesis is very much intact. And, a lot of people were texting me yesterday laughing, going, why is the oil selling off to $70 a barrel when you lowered your target 12 months out from 100 to 93? It's $23 a barrel below where your target is. So I want to emphasize to everyone, we're still very bullish, still believe in the longer term thesis. It's just that the near term upside has been taken out.
I think everything you talked about, except for the destocking part because of the higher rates, but you're not talking about demand. Can we tie this to any type of global slowdown or slowdown in this country? Does it indicate anything for the Fed, Jeff?
You look at oil demand, and here's a fact I like to just keep emphasizing. The IEA has raised its demand forecast every single month since November of last year. We nudged it down somewhat in this most largest upgrade, or downgrade in price, but it was a very small amount. And you look at how much we've raised it over the course of the last 6 months, it really emphasizes the demand picture is not part of this, which everybody likes to blame the speculators leaving this market because of demand concerns. I think it's more has to do with, the destocking, the higher interest rates, making it too expensive to hold a position. Oil is a liability to hold right now, not an asset. Until it becomes an asset, nobody's really going to want to hold it.
Okay, I get it. You also said that part of your supercycle thesis had to do with underinvestment, and you still said, look at this country. Everything's political, but a lot of people say when we say there's been underinvestment, too much regulation, the Biden administration has tried to curtail exploration. The Democrats always come back and say we're producing more barrels a year now than any time under the Trump administration. Which is it? Is there underinvestment? Are we producing less? Are we producing more than we've ever produced? I thought that the high prices would have spurred. Regardless of what politicians do, I thought that would have spurred investment.
By the way, that stat misses the point that production was massively curtailed through COVID. But I think the key message here is that when we look at the capital the ability of companies to deploy capital to drilling, given the fact that they destroyed so much wealth over the previous decade that they're wanting to return, returns to shareholder value through dividends, share buybacks. Otherwise, you're going to lose your investor. And so that's part of what's going on. So you're getting more of a normalization in CapEx than the aggressive growth that was characterized the previous decade.
All right, Jeff. Still, yeah, I noticed that. It didn't remind me quite of when an analyst, I like when they do that, they're like Netflix, it's trading at like 350 and they raise their target from 200 to 210. You know what I mean? It's like, what, you missed it. That's not the same for you. You're cutting your targets, but they're still way above where we are right now, still indicating sharp increases over the next.
By the way, I want to remind you, what was it, 6-7 weeks ago? We were above our end of year target. So it was, and how many times have we seen this market cycle between 73 and 88 since the beginning of the year? It'll be 3 times. Yeah. And a lot of that's driven by money coming in and out, in and out. It's unclear what the new money is that's going to come into this market. But one thing is very clear. They won't buy it until it's an asset. You need to have inventories draw, a positive carry, and a trendy market.